Welcome to this week's special presentation titled The Truth About the Stock Market. My name is Todd Shaffer, Manager of Research for VectorVest, and I'll be your presenter this evening. It's often hard to tell what's really going on in the stock market with all the noise and the spin you encounter in the financial media. The economy is slowing, corporate earnings are slowing, with forecasts revised downward, but still positive. Yet the VectorVest climate information says we're still in a bull market. What gives? Well, as you would expect, VectorVest takes a fact-based analytical approach to seeking the truth about what's really going on in the market. It starts with this fundamental understanding. Stock prices rise when their perceived value increases. Stock prices fall when their perceived value decreases. Good news and bad news can impact our perceptions about value of both stocks and the broad market. VectorVest actually calculates an intrinsic value for every stock in our database every day. We begin by tying that valuation to the financial performance of the company. Value is a product of earnings. When a company improves their earnings, they increase their valuation and command a higher price. So earnings is the engine driving stocks and the market. However, those earnings are not made in a vacuum. They're made in an economic environment of inflation and interest rates. When inflation and interest rates are low and falling, it's helpful to earnings and valuations. When inflation and interest rates are rising, it's a drag on earnings and valuation, and we're seeing a little bit of that now. VectorVest is one of the few services that includes these factors in our valuation model. Writ large, the market moves higher when earnings are rising, impacted by the environment of interest and inflation rates. Now, investors understand this, and they're always looking for opportunities to buy rising valuations and sell falling valuations, often adjusting their perceptions based on current market news. But not all news is relevant. To identify the most relevant news and information, filter it through the lens of its financial impact on a company's ability to make earnings or the economic factors of inflation and interest rates. We measure those impacts every day. How do we do that? Well, in his book, Stock Strategies and Common Sense, Dr. DeLito shares his approach on valuation, and if you want to take a deeper dive into our methodology, I refer you to chapters 3 and 4 within the book. But I'd like to broaden our conversation from individual stocks to the market overall. We know our probability of trading success improves if we go with the market flow, buy rising stocks in rising markets, sell falling stocks in falling markets. Earnings and markets tend to rise when the economy is improving, a bull market. Earnings and markets tend to fall when the economy is weakening, a bear market. What causes bull and bear markets? Well, it's an interrelationship of these factors. He spells them out in Chapter 9 titled Bull and Bear Market Scenarios. And here he identifies corporate earnings, inflation, and interest rates. With inflation lessens the value of financial assets, but it also erodes the purchasing power of consumers. Left unchecked, inflation destroys monetary stability and leads to a weak economy. The Federal Reserve Board is charged with the responsibility of maintaining monetary stability. It fulfills the task by controlling the money supply, and when the Fed sees inflation increasing, it tightens the money supply and interest rates go up. And regarding interest rates, fear of inflation always causes the Federal Reserve to raise interest rates to the point where a bear market is born. High interest rates ultimately stifle investment, weaken the economy, hurt corporate earnings, and lead to a bear market. We track several macroeconomic indicators within the program. You'll find them in the climate section of the views every Friday. Let's see if I can enlarge this so we can see the graphic a little better. The Investment Climate Report below tracks and documents two measures of inflation, the Consumer Price Index and the Commodity Research Bureau Inflation Index, three measures of interest rates, 90-day T-bills, 10-year T-notes, and 10-year AAA corporate bonds, and S&P 500 earnings average, the S&P 500 index performance, the New York Stock Exchange advanced decline performance, and the percentage bullish advisors sentiment measure. The way it works is you'll see the current level of the indicator, but then you'll see on a weekly basis the trend analysis of each of those indicators on a 0 to 2 scale. So values above 1 are favorable, values below 1 are unfavorable, And across the weeks, you can see if they're trending better or weaker. So for an example, CPI inflation at 5% on the current data at the time the slide was taken at 0.49 is below 1, so it's unfavorable. Looking back over the previous 4 weeks, we can see that level of 0.49 was stable over the past 2 weeks, but has fallen, gotten worse relative to the 4th and 5th week. So earnings at $7.29 were trending higher. That trend strengthening from the prior week, the week before that, and the 2 weeks prior to those. So we can see the earnings are trending higher and strengthening over time. Now we can see this information graphically within the program. Let me open VectorVest. So we're here in current time. I'm going to begin actually in the Viewers tab and go to a watch list viewer because the source of our information here is the S&P 500. The watch list contains the 503 stocks that are currently in the index on an unweighted basis. And we're sorting them, of course, by VST descending. But the important part is down here, we have the average. So these are the average data points for each of the indicators within the table. So currently, the average earnings per share for the S&P 500 stocks is $9.71. If I right-click, I can view the watchlist average graph. Now we have a 1-year graph of the S&P 500 watchlist price. So this is the average price for the watchlist and the average earnings per share data over the past year. And here we can see easily that while the S&P 500 peaked on December 30th, the earnings per share have continued to improve right up to today. But I also noticed that the slope of the line for earnings has really flattened out since the market peaked in that time frame. So let's add earnings growth rate to our graph. And here we can see the rate of growth has plateaued and actually now started to weaken. It's still positive, but weaker in the current time frame. So remember, the average earnings per share level is a leading 12-month earnings per share number that's determined by using a combination of 12-month trailing earnings and the most current earnings estimates. This method of tying the trailing earnings to the earnings forecasts increases the credibility of the VectorVest forecast. The average earnings growth rate represents the leading earnings growth rate. VectorVest is the only service that provides this type of forward-looking earnings analysis. But our next step is we want to analyze the trend of these earnings on that 0 to 2 scale. So that begins by, first of all, smoothing the earnings data by applying a 50-day moving average. Let's take earnings growth rate out of the way. And so we can see how the moving average of earnings smooths that data line, but it's also still moving higher. So we analyze that trend in our climate graph. So let's change our graph type to a market climate graph. So now we're plotting the data that we found on the climate table within the VectorVest views. We have over the 1-year period the 50-day moving average of earnings per share and the earnings trend indicator, the 0 to 2 scale trend analysis of the earnings performance. This data is updated on a weekly basis. So if I put on my date line currently, we see that the earnings, and let me put that on top so it lines up with the chart. Earnings at $9.59, that was last Friday's data, was higher than the week before at $9.57, higher than the week before that at $9.55, however, lower than we saw on the 3rd at $9.64. We can do the same with the earnings trend indicator, where we peaked at this value of 1.36, dropped to 1.35, dropped to 1.34, this past week dropping to 1.33. So on that 0 to 2 scale, we're still above 1. We're still in uptrend. However, that uptrend is weakening as the values have been pulling back from their highest level. Well, weakening uptrend is vastly different than downtrend. But market participants are front-running the narrative of a weaker economy and a weaker earnings picture. And when you think about it, that happens all the time. If I add to our graph the S&P index, and I'll flip the graph around here and clean it up so it makes more visual sense, but we can see the market is often ebbing and flowing, advancing and declining as it responds to the different stimuli that come down the news stream in any given market cycle. But let me plant the seed. This price action is much more volatile than the earnings and earnings trend analysis that we're performing on the broader market. So I really am establishing two different time frames of analysis, a longer term, slower moving time frame of analysis for the earnings per share performance, and a much faster analysis of the market price performance. Remember, investors and traders are forward-looking animals, meaning we're buying future performance. No one knows for sure what a company's or the market's sustainable growth rate will be or when it will be over. The transition from high growth to slow growth or even negative growth is a scary experience that usually causes considerable anxiety among investors. The slightest hint of an earnings slowdown can cause a stock's price to fall and investors to run for the exits. At the higher market level, the same is true when macro forces threaten earnings broadly, especially inflation and interest rates. Dr. Toledo next in the book shares how we analyze the different combinations that we can have of earnings, inflation, and interest rates and their impacts on market prices. We call it the truth chart. And you can see that we have a scenario, 8 scenarios in all, for each of the possible combinations of earnings, inflation, and interest rates. Each set has a case number, and we go through a description of the cases and their typical implications. But two things: recognize that we don't have to go through the cases in order. We can go from a case 1 scenario to a case 4 scenario, back to a case 2, then back to a case 4, right? So we can bounce around within those different scenarios. But the high-level takeaway for you is when earnings are up, we're in a bull market scenario. When earnings are down, we're in a bear market scenario. And whether earnings are up or down is determined by the ETI. Is its level above or below 1? And that's how we can say, if we go back to the program, that's how we say in both the overview and the climate sections, we currently have a case 4 bull market scenario in which earnings, inflation, and interest rates are rising. So investors are constantly balancing these factors against each other. We know rising inflation and interest rates are not good for stock prices. Nevertheless, investors will keep pushing stock prices higher as long as they perceive earnings to be going up fast enough to offset the negative effects of higher inflation and interest rates. When that combination changes, we look for investors to lock in profits, stall the market, and create a healthy dose of PE compression. In other words, repricing. So the market's perceptions are becoming reality, but is it true? Dr. Toledo wrote in his essay from November 16th of 2018, "Perception is the reality." Angie referenced it recently in her essay. Given that it is commonly believed that the Fed will raise interest rates, the economy will slow down, and corporate earnings have peaked, millions of predictions have been made of an imminent bear market. While I don't agree with those predictions, millions of investors, including the bearish financial professionals who appear regularly on TV, can and do move the market. I can't help it when a majority of investors believe earnings will be lower when they're still rising. and they can take the market down for the wrong reasons. I don't move the market and I don't fight the market. Their perception is the reality. And I'll conclude with his essay from May 22nd of 2020, back in the COVID crisis. The bottom line is that the truth chart provides a strategic analysis of the investment climate. Our market timing system will provide you tactical signals such as when to buy and when not to buy. It's often hard to know the truth with all the noise and spin you encounter following the markets. As you would expect, VectorVest takes a fact-based analytical approach to seeking the truth about what's really going on in this market. Thanks for watching.